Well, good morning or good afternoon to everyone, depending on what part of the country you are calling in from. My name is Ginger Bell, and I am your host today for our webinar introducing the TCF Bank Second Lien HELOCs. And today, this information is presented by Finance of America and TCF Bank. So as you're getting logged in, I'm going to go through and share with you how you can ask questions today on the webinar. First of all, I'll be controlling the slides for you, so you do not need to do anything to be able to move the slides along. I have put into the chat box a copy of the slide deck, and I'm going to go ahead and do that again real quick here. So you can actually click on that link and print off a copy of the slide deck if you'd like to follow along or have access to it. If you do have questions today as we go through the information, you can ask those by typing in the question panel. And this is a different platform for doing a webinar from what you may be used to, what we've used in the past with GoToWebinar. And I know I've done thousands of webinars on the GoToWebinar platform, but we moved to the Zoom platform because it's a little bit newer technology and we can actually accommodate more people. And we have several hundred registered for this webinar, so we want to be able to accommodate everyone. So a little bit different as far as asking questions. And I want to go ahead and make sure that you know how to ask questions. So if you can click on that QA panel that you have, it says Q&A, and type in there hello and let me know what part of the country you are calling in from. That way I know that you all can hear me and I'm not talking to myself here, and that you know how to ask questions. And yay, it works. Excellent. So a happy Good Friday to you. I see a lot of you are working today. Some companies actually are closed today, but we're happy that you joined us today. And we wish you a happy Easter weekend and hope you're doing something very fun this weekend. I think we were just talking before we were getting ready on the webinar. Not a lot going on for me for the weekend, so I think we might end up going skiing or something. It's one of those last weekends to get those things in. So hopefully you have something good planned. And I see you all can hear me, so I'm going to go ahead and go through the panels here. If you have questions, as you know, type them in there. You can, if you're hearing this, then obviously you can hear us, but you can either listen on your computer or you can call in. So you can check your audio there by doing that. And if you can't hear us, you can see that on the screen, and that's how you want to be able to access the audio, so you can do that. But it looks like everyone is logged in here, and so that is a good thing. And so I want to take a moment and introduce myself to you. My name is Ginger Bell, and my company is GoToTraining. I am a consultant for Finance of America, and so I'm hosting this webinar for them today. And you may have had me on other webinars in the past. And so I also want to introduce to you our panelists who are with TCF Bank. But before they do that, I actually have lost my little icon for the webinar. So I need to go and grab that again. And that way I can make sure that you see me. So let's go, and there we go. I want to get my little icon back there, so I know you all are back there again and I can see you again. So okay, gotta love technology. So let me introduce to you our panelists. We have two panelists with TCF Bank, and we're very excited about having them on board. And Joanne Fabiano has been in the mortgage industry for 25 plus years, and she's been with TCF Bank for 5 years. And she loves helping her customers discover the benefits of the combo versus the jumbo. I love that saying, Joanne. And Joanne's TCF team is actually based in Minneapolis, Minnesota, but she's lucky enough to live and work in Northern California. And then we have John Mason, and John is the assistant manager with TCF Bank. And he has been with TCF for the past 4 years. He is also a 3-time TCF Annual Customer Service Award recipient, so that's fantastic. And then he's also passionate about baseball and, of course, the Minnesota Twins. So, Joanne and John, thank you so much for joining us today. So, I want to make sure that you all can still hear me, and it looks like you can. And I'm going to go ahead and get started then with all of the information. And we're talking about a very exciting program and what we're calling the perfect pairing. And it's the FAM first with the TCF Bank HELOC second. And so these are available now. A great opportunity, and really when you're thinking about marketing, and that's one of the best things to think about as far as how you can leverage this into your marketing plans. It's a great opportunity for those who are over the high balance limits, that have jumbos, and also for those who want to avoid mortgage insurance or even the jumbo overlays. And so with the TCF Bank HELOC, it is an opportunity for you with a minimal amount of additional documentation. Finance of America will facilitate the TCF Bank HELOC, and they will both close simultaneously. And FAM is one of the very first wholesale lenders to offer the TCF HELOC. And this is a great opportunity for you as a third-party mortgage broker to be able to offer this into your product mix as well. So what we're looking at, and I'm going to go through the highlights, and then we're also going to get into some of the guidelines and details of it as well, is it's a combo. So it's the FAM first with the TCF Bank HELOC second, and it exceeds, it's an opportunity for you to get into markets that are looking to exceed county limits by offering a combo loan, obviously, versus a jumbo loan. There provides for an opportunity with no mortgage insurance on CLTVs above 80%. The loan closes simultaneously. There is a minimum on the TCF HELOC, which is $5,000. The maximum TCF HELOC is $350,000, and the maximum CLTV is 89.99%. And there is a requirement as a credit score to have a combo first and second up to 1.5 million. And it's also available besides a primary residence for vacation homes, and we'll get into those requirements. So what you're looking at for a purchase or refinance on a primary or a second home with a 700 minimum FICO score, and that minimum FICO score is on the primary wage earner. So you're looking at a CLTV maximum of 89.99%. Combined liens, so first and second, is $750,000. Again, the maximum HELOC is $350,000. The minimum is $5,000. Now, if you have a primary wage earner with a 730 minimum FICO score, then that combined lien value goes up to 1.5 million. Same max on your CLTV, and same max on the HELOC, and same minimum, but obviously a higher loan amount. For your second homes, vacation homes, then you're looking at combined lien of 1.27 million. That goes down on the maximum of the HELOC to 250,000, minimum's 5,000, and your maximum CLTV is 1.27. Excuse me, maximum CLTV is 85%. There's 3-tier pricing, and the max, anything that's over the CLTV, it's a prime plus 1.99%, start rate of 5.99%, and that's based on the current prime rate of 4%. For your CLTVs between 70.01 and 80, then it's a prime plus 1.49 with a start rate of 5.49%. And then the CLTVs below 70%, it's the prime plus 0.99% with a start rate of 4.99. So the 3-tier pricing options are important to pay attention to there. And really, it's a minimal amount of documentation to be able to close these simultaneously. And the process is very simple as well. So beginning with, you download the forms, and within the FAM portal, you can find that there are all the forms available there. And so you have the TCF Bank HELOC library, and that's where all of the forms are located. And when you submit this, you want to indicate to add a HELOC. And so FAM has a new submission form, and you utilize that. You will complete and submit with your first mortgage the WSL notice and authorization form, and I'm going to go through that in a little bit, what that looks like. And then you will also complete and submit along with the first mortgage, the WSL qualifying worksheet. Now, there are some additional forms that are required for Florida, New York, and Maryland, and unfortunately, the TCF HELOC is not available yet in Alabama, Alaska, Hawaii, Mississippi, Oklahoma, Texas, and Virginia. The great news is that because you are a FAM customer, you are automatically approved to do business with TCF. So this means that you can offer the first and the TCF Bank HELOC right now. It is available right now. And so before we get into introducing John and Joanne and the TCF bank opportunities here, is I actually want to take and do a quick little poll and make sure that you all are paying attention and can interact with us. So what you see on your screen, if this is working correctly, is a poll, and you can click on that. And I just want to find out if you're currently doing first and second combos. Obviously, 3 options there: yes, no, or you would like to. Because again, this is one of those opportunities. If you are looking for ways to stand out, this is a marketing opportunity for you to be able to say, hey, we can do this, get into markets. You know, Joanne, you're in Northern California, and boy, I tell you what, that's an area that definitely needs this. And one of the things that I love about it is also available for second homes. So that market is definitely coming back right now, and it's a great opportunity. So I'm going to end this poll and share the results. So it looks like more than half of our audience would like to, that you don't have that opportunity right now, and that you're interested in doing that. So that is fantastic. And with that, I am going to turn it over to Joanne, who is going to share with us information about who TCF Bank is and the great opportunities we have here. So Joanne, I'll let you go ahead and share some information about TCF Bank and the power behind what you have here.
Thank you, Ginger, and how excited to be chatting with all of you today. So I joined TCF Bank 5 years ago. That's when TCF began originating these second lien HELOCs. Prior to that, we'd only been doing HELOC lending within the bank footprint, which is pretty much the Midwest. So we have 5 years experience now originating this product. Our team is very, very seasoned in many, many major markets. And TCF actually originally stood for Twin Cities Federal. We are a $20 billion national bank based in Wayzata, Minnesota, which is a suburb of Minneapolis. We're traded on the New York Stock Exchange with a symbol TCB. We've got a wonderful service team in Plymouth, Minnesota, and John Mason, who you'll meet later, is going to be the person in charge of that team. When I joined TCF, this was originally going to be a portfolio product, and I think we realized pretty quickly how much of this HELOC business we would do nationally. So we began to develop a set of investors that would buy this product from us on a regular basis. And this is now a pretty robust secondary market that buys our product. And that's important for you to know, because you're not going to have to be concerned that one day TCF may suddenly say, we just have enough of this in our portfolio. We've got a secondary market that wants to buy this product, and we retain the servicing.
That's fantastic. And I know you have states that you're servicing and not servicing right now. So that's important, obviously, to remember that there are certain states that you are not servicing right now with this product.
That's correct. So the states we're not servicing include Alaska, Alabama, Hawaii, Mississippi, Oklahoma, Texas, and West Virginia.
Okay, great. So unfortunately, if you're in those states, not available right now, and not necessarily knowing that they'll come available, but Obviously, the state's a big area that is available, and some of those really important states where the jumbo is so prevalent. It's an opportunity to be able to get into those markets. So let's look at the reasons and really the market opportunities that you have with this FAM first and with this TCF Bank HELOC second. And John, I'll let you go ahead and take it away and share with us some of the reasons to offer a TCF HELOC.
Thanks, Ginger, and good day, everyone. Happy Friday. So I'm just going to talk about a couple of reasons for offering the TCF HELOC. The first one, I think probably most apparent, is the 80-10-10 TCF or first and second, and that will allow your borrowers to avoid any sort of mortgage insurance, and they have the ability not to escrow impounds on the first. It's also a nice last-minute add if you're refinancing a borrower out of a mortgage insurance loan, but your appraisal comes in lower than expected, and it's going to go over that 80%. You can add that TCF HELOC onto that. The HELOC is also a very flexible product that the borrower can draw only what they need from the line, and they'll pay interest only on that amount. So we don't require them to take a full draw. They can take a partial draw or a zero draw when they close on the second. We see quite a bit of borrowers add the HELOC and set up a zero draw with no intentions to utilize it down the road, or with intentions to utilize it down the road for home improvements, children's college funds, or simply just a security blanket. They can also use this as a revolving loan for the first 10 years. Another great utilization for the TCF HELOC would be on a departing residence that is selling later, but paying the line, or sorry, the departing residence that is selling after close. And once that departing does sell, they can pay the line down to zero, and they can keep it open for, again, future availability, or they can close it down as we do not have any prepayment or early termination fees. And the interest may be tax deductible, but we always advise our customers to check with a tax professional for sure if it is tax deductible. Sharper first mortgage pricing. So again, everyone kind of obviously knows about the 80-10-10, but think about if you reduced your first mortgage down to 70% and added a HELOC on to make it up to 90%. That pricing on your first maybe get a little better for you and your client, and that's going to be on the majority of the money being borrowed. The product does not have to be 80-10-10, and we see clients structuring a lower CLTV first mortgages to get that better rate and taking the TCF up to 89.99% for the lower down payment. As long as the TCF line doesn't exceed $350,000 and the CLTV is at 89.99% or below, you can structure the deal that best fits your customer situation. And I think I actually saw a question on the chat about this with reserve requirements. And I think that was Leon. And we do not have any reserve requirements. We don't validate any assets, and we are even okay with the down payment being 100% gift. We also don't have any reserve requirements. So even if you're doing a jumbo and doing a TCF second behind a jumbo, we're not gonna validate anything with reserves. If you have a borrower who's having a tough time meeting reserve requirements on a jumbo loan, going down to a conforming first and adding a TCF second might be a perfect option for them. Limited trade lines. So we do require 3 trade lines, and that can be combined between any of the applicants on our loan. So it doesn't have to be just the primary wage earner. If you have a non-primary wage earner that has 3 trade lines and the primary wage earner that has 0, we are 100% okay with that. The trade lines can be open, closed, revolving, or installment loans, and we just need 1 trade line that has been open in the last 36 months. Authorized user accounts would not count towards this though. We are also okay with borrowers who are here on a work visa. So if you're having a situation on a jumbo product where you can't get the borrower qualified due to his status, we are okay with the work visa. And if they are here recently and are lacking the credit with the 3 trades or the 36-month history, we will accept a foreign bureau to satisfy that requirement.
So we're getting a couple questions in too, which we'll probably get through some of them later on. But let's talk about credit scores and debt consolidation. Obviously using other income. So looking at some of the things that TCB is going to be looking for there.
Yeah. So one thing is if you have a borrower that has a weak credit a weak credit score. I know you guys may be accustomed to using the lower credit score between the two borrowers to qualify on the first. The nice thing with TCF is we always use the primary wage earner's credit score to qualify. So if your primary wage earner has a 780 credit score and the co-borrower, who is the non-primary wage earner, has a 660, both borrowers could be on our loan and we would qualify it at the primary wage earner's credit score of 780. This is also a great option to add a borrower on our loan that is not on the first. So if you have a situation where you're not having a co-borrower on due to a low credit score, you can add them on to just the second. The only requirement that we would have is they'd have to be on title. And then debt consolidation. Obviously, this is a big utilization for our customers. If you, they might have a preference of paying off debt, but also if there's a back-end DTI issue, one great solution is to have the borrower pay off debt with our loan. We do see a lot of borrowers specifically doing a TCF second to consolidate debt. And the nice thing with us is any revolving debt that we do pay off to zero, they do not have to close that account. They can leave it open after the fact.
Well, that's great.
And then yeah, that's a big one. And then rental income on the departing. If you have a borrower that's planning to rent out his departing residence, we are okay with that. All we need is a 12-month lease and a proof of security deposit, and we're going to use 75% of the lease amount, and we'll wash out any departing resident housing liabilities with that. And then what about those HELOCs that reset in year 11? So there are a lot of borrowers out there that had HELOCs 9 or 10 years ago,
right?
And those HELOCs are set to reset from an interest only to an amortized payment in year 11. That's going to be a substantially increase in their monthly payments. Might be a good time to refinance those borrowers and give them a new TCF HELOC, and they'll go back to the interest-only payment for the next 10 years.
Right. And that's a great point, John, as far as getting into, if you're getting any kind of lists, whether it's from, buying lists or title companies on these HELOCs that are resetting, then this is one of those opportunities to be able to get into that. Now, we had a question I'm going to address now, and I know you guys, I'm seeing lots of questions coming in, and a lot of the questions we actually are going to get through as we go through the information. So we'll probably be addressing some of those, but one of the questions I saw, which we don't have a slide for, is can the HELOC amount be larger than the first?
Absolutely, absolutely. We do have situations where the first might be $150,000, and they might be using our line at $350,000. That's 100% okay with us, as long as it meets our CLTV, and the max line amount on the TCF second is $350,000. But yeah, there's a lot of situations with borrowers where, given their situation, that's going to be the best option for them. So yes, 100% okay with that.
Okay, perfect. And again, I'm seeing a lot of questions coming in. So I think Joanne and John, if you can see them scrolling down, I'm going to go ahead and we'll keep going on through this information, and I think we'll address some of these at the end. So continue to ask questions in there. I love seeing this because that just tells me that you guys are excited about this product. So John, I'm going to pass it on to Joanne, and we're going to cover a couple other reasons for offering this, specifically talking about the jumbo market. So Joanne, and again, you're in Northern California, so you know this market very, very well. So
Absolutely.
What are the great benefits of doing this and going jumbo?
Well, it's interesting because 5 years ago, there was no jumbo product.
Right.
And the jumbo product, of course, began to come back into the marketplace. And I really remember wondering how much this would cut into the demand for a first-second combo. And my customers have taught me that there are so many times when you simply cannot go jumbo. It looks like a good loan to you and probably like a good loan to me as well, but it just does not fit those jumbo investor guidelines. So probably the number one reason why you're on this call today is because you're in an area where you want to be able to create jumbo financing by adding our HELOC to your conforming or high balance first, or you realize that you've got one small element to that jumbo loan that's just not going to work for the investors. So that's really what we jokingly refer to as jumbo rescue. Some of the things that we talked about earlier with the fact that there are zero reserve requirements, and that's so critical when you're looking at jumbo, the fact that we don't require installment debt, the fact that we don't require both borrowers have seasoned trade lines. In addition to that, some of the things that TCF will allow are recently listed properties. We've seen so many borrowers who had their homes on the market, realized they couldn't have an offer accepted. Now they're going to go ahead, take their house off the market, and stay in that home. Those borrowers are ideal candidates for a HELOC because they're going to stay in their home, and now they want to add the pool in the backyard or redo the kitchen. So we will allow properties off the market just one day. I think in the agency world, that might restrict you to an LTV of 70%. And of course, you can put this together as a 70-20-10. We also see a lot of transactions where it's a gift of equity, non-arm's length transactions, mom and dad selling the home to their children. TCF allows that. We do not require installment debt. I mentioned that earlier. I think we have a real common sense policy for borrowers who are returning to work after a gap in employment. I've seen many transactions where the borrower has great work history, great training for their profession. They take a break from work, maybe they're starting a family, and when they come back, the jumbo world is going to require that they're back on that job for a minimum of 6 months. TCF will work with that borrower immediately, knowing that they've returned to work. As long as it's full-time, straight base pay, we can use an offer letter, an employment contract, or of course, pay stubs backed up by a written BOE. We require 12 months employment history, but that does not have to be continuous. So we can go ahead and look at that gap as long as we have a total of 12 months in that same field. Also, we can use education, higher education especially, as part of their work history. So you may have someone who graduated with a degree and now they're in the workforce for 2 or 3 months. We can go ahead and use their education as part of our 12-month employment history. We see borrowers who are starting to look to establish a distribution from their retirement account. TCF will allow that as qualifying income, even if it's a brand new distribution. Those are some of the things that don't work well in the jumbo world.
Yeah, definitely, and great ideas.
So TCF is going to order a desk review on the appraisal. And we order that desk review on every appraisal, regardless of CLTV. There's a lot of benefits, though, to the fact that we're ordering that desk review. We rely on that desk review value. So for example, if you have a flip, TCF is not going to have any specific seasoning time after for the amount of time that the seller owned the property. We're going to go ahead and just make sure that that value is supported by our desk review. We also rely on the desk review if there are any unpermitted improvements. We don't have specific limitations anymore on that. We rely on the desk review to support value. We don't have any title seasoning or continuity of obligations, so we now match up with the agencies in that area. TCF will actually use income from restricted stock units if the borrower has a 2-year history of receiving these awards through payroll. Now, you may not be able to use RSU income on your first mortgage, but what's important to know is when you're qualifying for the HELOC, if you wish you had a little bit more income to qualify, even if you don't need that income for the first, you can apply income like restricted stock unit income to qualify for the HELOC. TCF requires 2-year self-employment history, but we will follow the AU findings for just 1-year tax returns. So we're not selling these products to Fannie or Freddie, and we really don't follow findings per se, but we'll follow the specific finding for 1-year tax returns. We also allow asset depletion as a form of income, 70% of the savings accounts divided by 360 months. And then, of course, converting a departing residence to a rental. We see that transaction quite a bit. And once again, we're going to take that 12-month lease, proof that a security check has been deposited, and we'll apply 75% of that monthly income to offset or wash the PITI and HOA on the departing.
That's great. So, Joanne, I'm going to ask a couple questions, and either you or John can either answer it now or we can answer it at the end, but I just want to put them out there because I'm seeing them here. So, for current HELOCs to refinance, can they do a standalone, or do they have to refinance the first at the same time?
We are a piggyback lender, so we always are going to need a new first to piggyback off of. So we don't offer a standalone HELOC. It's always going to be a first-second combination.
Okay, good. And is there a seasoning requirement to pay off a modified lien?
There is not.
Okay, good. So I'm seeing some other questions coming in here. I'm going to push those off, and we're going to actually talk about, let's see, we've got through our rescue ideas, and so let's get into the general guidelines. I'm going to go through those and just talk about some of the general guidelines for the term. So it's a 30-year HELOC, and so your years 1 through 10 are your draw period with an interest-only payment. Years 11 through 30 become your repayment period, and that's with payments that are amortized over the remaining term, and it's an 18% life cap. So I saw a question earlier on what the term was. So it's a 30-year HELOC term. There's an annual fee, $75, which is the annual maintenance. It's collected with the first statement. And there is no early termination fee. John talked about that as well. So this is one of those that, you know, if they want to get this when they're purchasing, just as a just in case, because then, and they decide they don't want it, then there's no early termination fee. As far as the draws, borrower can choose either full draw, partial draw, or zero draw. So that's a great opportunity to, you know, to hang on to something. It's like, hey, you know what? Kids are getting ready to go to school, or you know, we're maybe expecting, you know, down the road we want to be able to do some traveling, whatever that is, or remodeling, or whatever. This is a great opportunity to be able to just say, hey, you might as well have access to that. Now, we had a question as far as can you as a broker get paid on this? You are not paid on the second. There is an origination charge, and it is put on the line. There's a net wire sent to closing. The borrower is responsible for the title fees. So what happens is FAM's underwriting fee and admin fee on the first then combines with the TCF second. And so that becomes $12.95 in California. Actually, it's not available in Hawaii. And then it's $11.95 in all other states. So that's going to be a combo in there. And you're only paid on the first. So your compensation is only paid on the first. So let's talk about some of the qualification guidelines. And one of the things that you will need, and this is available through FAM Platinum, it's the qualifying worksheet. And so what you do is use this, put your numbers in there. It'll calculate a 30-year P&I HELOC payment, and it has the start rate, and then it'll also include a payment shock factor. And the HELOC loan amount is multiplied by a percentage, and it must fit into the ratios. So your TCF ratios are 30 out in the front, 45% debt to income, and there's no exception to either ratio. I know that was one of the questions that we had. So this is available on the FAM Platinum web portal right now, but that's what you're going to be starting with as far as going through the qualification. Credit scores we went through a little bit earlier, so we will recap that. So the primary wage earner, and that's the borrower with the most income. So your primary wage earner must meet the TCF minimum mid scores. Your combined lien is $750,000 or lower for a 700, and that again is your primary wage earner. And then for combined $750,000 greater than or a second home, you need a 730. There is no minimum score for the lower wage earner, so the credit is based on the primary wage earner. The trade lines, you need a total of 3 trade lines, and it's all borrower's credit combined with 1 trade line seasoned for 3 years. The accounts can be opened or closed. No installment debt or VORs are required. No trade line activity rule, and authorized user accounts do not qualify as a trade line. There's 5-year seasoning for short sale, foreclosure, or any real estate transaction that was settled for less than owned, and bankruptcy policy is no BK filing in the last 8 years, and that's based on the filing date. Looking at your income guidelines, and John talked about this a little bit as well. So self-employed borrowers, you need to have 2 years self-employment history. It's required. For your K-1 income, if the borrower is 100% owner of the business or 100% owner with the other applicant, then you're going to use a taxable income with adding back your depreciation. If the borrower is under 100% owner, you're going to use the guaranteed payments and distributions and any items affecting shareholder basis. And so you cannot use taxable income. For expenses, TCF does not deduct the 2016 expenses from the income. And for tax returns, they're not needed for W-2 employees. Non-taxable income, TCF does not gross up non-taxable income. And Joanne talked about some of your job history and your employment gap. So 1 year job history is required for W-2 employees. And this can include education. So the work history does not have to be continuous. And signed and dated LOEs are needed for gaps that are greater than 30 days. So if you have, in our millennial market, this is one of our biggest markets right now, especially for our first-time home buyers. I think the National Association of Realtors had put out some numbers that more than 60% of the purchase business this year is going to be coming from our millennial market. And so for those individuals that are graduating, and a lot of them are going on, it's not just a matter of getting their bachelor's degree, a lot have gone on and continued to get their master's and are now just getting into the job market. So that job history can include the education. So again, looking at marketing opportunities, that is a great opportunity to be able to get into that. And so your income guidelines, the highlights, your job history and employment gaps, 1 year job history, we just went through that. Non-resident aliens, you require the borrowers to live and work in the U.S., but do not require a 2-year history in the U.S. And visas are allowed for all types of work visas with the right documentation. So if you have someone that's going into that, you want to check with your FAM account executive to get some information on what the documentation is for that. Property guideline highlights for your property, it's a single family, 1 and 2 unit properties are acceptable. The appraisal desk review. So once TCF orders the appraisal desk review, they will not accept a rebuttal for a higher value. On condominium projects, if it's an existing project, then the minimum is 51% owner occupied. A new construction project, of the units that are sold and closed in each phase, at least 70% must be owner occupied. 10 acres in all states are maximum, except for Arizona where there is a 2-acre maximum. And no seasoning to use the current market value. So this is including flips, as long as your desk review supports your value. Unpermitted improvements, there's no restrictions as long, again, as the desk review supports the value. And non-arm's length transactions are allowed. Gift of equity is allowed, and a property off the market for 1 day is okay. So all fantastic things to be able to use and to consider. Your asset guideline highlights reserves, so there's no reserve requirements on the second. Obviously, any requirements that you have on the first are still into place, but when you're looking at, if you need to meet certain requirements or get approvals, you can lower the LTV on the first and pick that up on the second in order to meet any kind of guidelines that you may be falling into. So those are things you want to work with your Finance of America account executive and make sure when you're structuring these combos that you're structuring in the best qualification for your borrower and to work through those. Down payment, no documentation required for source of down payment. And again, this is on your second. Gifts are allowed, even a full gift with no borrower contribution. And for documentation, there's no bank or asset statements that are required unless you're using it to document your income. So overlays, and I'm going to let John hop in here and talk about some of the overlays that are important to look at, especially when you're doing this as a combo. So let's talk about some of the debt to income ratio, John.
Thanks, Ginger. And I just saw a couple of minor questions here I can address. So there was one that said, is it supposed to be 2106 expenses and not 2016? And that is correct. So
it is.
We do not exclude, or we do not account for the 2106 expenses. So that is 2106. All right, so the max DTIs that we have, as stated before, are 38 on the primary housing ratio and 45% on the back end DTI. The TCF will qualify at a 30-year PI at the initial start rate, so based off of your CLTV. And we're also going to add in a payment shock, which is going to be 0.0018 times the full line amount. So if the borrower is taking a zero draw, we're still going to have a payment shock of the full line that the borrower is applying for. Both these liabilities are added into the front end and back end DTIs, and we are hard set on the 38% and the 45% ratios. Rental income used to offset PITI and HOA. We can use rental income off of leases or Schedule E to offset investment property liabilities, but we cannot use the positive cash flow. So if you have a borrower that you're using positive cash flow on rental properties and you're using the income on it, we would offset that property to zero, hold in no liabilities, but we also would not use any rental income. To stay on rentals, and probably given the how we look at the rental income above, our max other properties is 6. I think somebody had a question on this. So we have the primary residence or the subject property plus 6 other properties. And we consider other properties as free and clear, financed, investments, commercial, or second home. Those would all be included in other properties the borrowers have. And again, the maximum is 6 plus the subject. We do require a full appraisal. So the appraisal would have to have interior and exterior pictures, and it is required on all loans. And I think Ginger may have said that about the desktop review supporting value. We do a desktop review, so we would not use your desktop review in any situation. It's a TCF desktop review that we perform. PIWs are not accepted, and the maximum acreage is 10, with the exception of being Arizona, which the max acreage is 2. Non-occupant co-borrowers, we do not allow non-occupant co-borrowers. Any borrower that's going to be on the TCF second would have to be occupying the property, with the exception, obviously, the second homes, but they'd have to be their second residence, and no blended ratios, so no non-occupant co-borrowers and no exceptions onto that.
Right, very good. And so Joanne, let's talk about going into, as far as looking the calculation. And I know one of the questions we have is there a worksheet that they can utilize to make sure they're calculating all the income correctly? And I think that's part of what's included in one of the worksheets, right?
The TCF worksheet is going to calculate the amortized payment and the payment shock and run the ratios for you, but it's really not designed to calculate income. So what you want to do is work with your FAM wholesale account executive to make sure that you're calculating income correctly. But basically, for income, for your W-2 employee, we're going to be looking at 2 consecutive pay stubs and a W-2 for the prior year. If you've got borrowers who have varying pay, which can include shift differentials, part-time work, overtime, bonus, commission, TCF is typically going to be using a 15-month right now average, which is 12 months for 2016, plus currently 3 months for year to date. We're going to use that average. The only time we don't use the average is if the current year income is declining by more than 20%. In that case, we'll use the lower income. But those are the basic guidelines for income calculation. As far as installment debt, this is a TCF overlay. We will include installment debt in our DTI calculations if there are more than 6 months remaining. Now, what you can do if you've got installment debt and there are more than 6 months remaining, you can use the TCF HELOC to make additional payments to bring that down to 6 months less or more remaining, so we can go ahead and exclude it from DTI calcs. So you definitely can bring down the remaining installment debts with the HELOC at closing to go ahead and to get into the 6 months or less position and not have us include that debt in our DTI. There's only one TCF HELOC allowed per borrower, So we've been originating these HELOCs now for 5 years. You may come upon a situation where the borrower wants a HELOC for their new transaction. They may already have a TCF HELOC on the departing residence, and if they're going to choose to keep that and convert it to a rental, you're going to be in a situation where they'll have to pay off the existing TCF HELOC if they want to obtain a new one. TCF does not lend on manufactured homes, mobile or log homes, also dome homes. That doesn't come up too often. And I think we've already covered our policy on ordinary business income, which is basically if your borrower, if there are multiple partners and they are not on our loan, we will not be able to use ordinary business income, which is typically in box 1 of your K1. But what we can use are distributions, items affecting shareholder basis, guaranteed payments, and compensation to officers. So be a little bit cautious if you've got a transaction where you've got multiple partners. Take a look right away to determine if the income is showing up as ordinary business income. Many times it's in that box, but it also shows up as a distribution, which we can allow.
Right. So great. So one of those things too that we want to make sure, as Joanne said, work with your FAM wholesale account executive and go through that, especially if you do have someone who has ownership of a company, to make sure that you're calculating that the correct way. So let's look at some of the pricing and product tools that are available on this. So first of all, you'll refer to the FAM Platinum for current TCF pricing and product guides. And I know I've seen a couple of questions as far as being paid on the second. You cannot get paid even if you go borrower paid. So you are not paid anything on the second. This is one of those products that you get paid on the first, and it's an opportunity for you to pick up some of those loans that you're not getting right now. And so unfortunately, it's just one of those, you get paid on the first, you don't get paid on the second, even if you put it to a borrower paid. So and if anything changes on that, by all means, you can work with your Finance of America account executive. But this is, it's a great opportunity for offering a combo. You can also find the Excel qualifying worksheet that'll calculate the HELOC start rate, the 30-year P&I payment, and then any payment shock, and that's all calculated in there. So that's what you're going to use for calculating the second. It does not calculate income, as Joanne said, but that's one of those things, working through with your Finance of America account executive to make sure you're calculating that correctly. And so it's important to note, we talked about this, that obviously there is an application fee. It's combined in and it's accommodated for in your combo. So when you submit this, you want to submit it as a first and second combo. There is no compensation that's paid out on the simultaneous second. So it's one of those things that, again, it's an opportunity for you to get into that. The other thing that's important to note as far as going through the HELOC, and I'll talk about this in just a minute as we go through the file flow, but we started almost 2 years ago. It's hard to believe. October it'll be 2 years with the new disclosure, so loan estimate and closing disclosure. Now, when that change happened, HELOCs were not included in that. It's considered a consumer loan. So you're not going to be issuing loan estimates on the HELOC portion. You'll still have it on the first, but not on the second. So something to remember when you're putting this together too. So let's look at that, going through what the flow looks like. And again, all of these forms, everything is on the FAM Platinum portal, so you can access everything right there. So there's a submission form that's available. It has the second HELOC information on it. So things you're going to need to submit is that, the notice and authorization concerning your loan application form, the TCF qualifying worksheet, and your standard submission package. So those are the things you're going to get together. For disclosures, you're going to prepare your LE or your fee sheet. If you're having FAM, prepare your LE, and it must reflect the correct fees, because this is obviously a combo, And so you want to make sure that you're doing that correctly. So again, California, Hawaii, Nevada, and Washington, TCF is not available in Hawaii, so want to make sure and notice that, or the 1195 for other states. On your disclosures, borrowers responsible for the title fees. Your TCF HELOC is, again, not subject to TRID. So you have your origination charge, $295, your annual maintenance fee of $75. And your TCF origination charge is put on the line, and a net wire is then sent to closing. And TCF mails the command credit HELOC disclosures to the borrower. So you're not going to be submitting those. TCF is going to do that. And John and Joanne, we may see some questions on that, so we can address those when we get to the end as well. Once you have that information for your disclosures, then I'm going to go to underwriting. You're going to get an approval on your first, subject to approval on the HELOC. And so with that approval, the underwriter's then going to submit the HELOC file to TCF for your initial approval. And you want to make sure, communicate, especially if you're doing a purchase, communicate with your realtor, with your borrower, so they can communicate with the seller. Typical underwriting turn time is 4 to 5 business days. You want to allow for that. So you have your first step, obviously, submitting it, get your disclosures in, goes into underwriting with FAM on the first. FAM's going to submit it then to TCF for the second, and you want to make sure and allow 4 to 5 business days for turn time for that. Once you get that approval back, then obviously you get your conditions, the brokers to upload all of your conditions along with the first. The FAM underwriter will submit any underwriting conditions to TCF, and then you want to allow another 4 to 5 business days for the desk review at that time. Then you get your clear to close, and docs go to title. Turn times, we've got 3 business days. TCF will require the first mortgage, the initial CD, to release closing documents. TCF closing docs are sent directly to escrow and title. So again, we have 2 different sets of docs here. So you want to let your borrower know about that. And this is one of those things that it's an opportunity for you to shine and being very well informed on the process, and just let them know. So, this is what's going to happen. Go through it with them. That way your borrowers know exactly what's happening as well, because they're going to get, especially on their initial disclosures, coming from a couple different areas. So you want to make sure and communicate with them what's happening on that. The TCF docs must be signed and emailed or faxed back to TCF within 7 calendar days. And then we go to funding. Escrow must notify TCF that they're ready for the funds. There's a wire cutoff time of 11 a.m. Pacific time, or 1 p.m. Central time. So that's the flow that we go through. And again, this is something you'll want to be able to work with your FAM wholesale account executive to get through this, especially your first one that you get going. So let's look at the requirements. What is needed to submit a combo? So we just went through the forms. They're available on FAM Platinum. It's under the Resource Center, Loan Forms, TCF HELOC. So that's where you're going to find everything there. When you submit, you want to indicate to add a FAM facilitated TCF second lien HELOC on the new submission form. You'll complete and submit this with your first mortgage, along with the notice and the authorization form, and have the applicants execute that. An electronic signature is acceptable. And you'll submit along with your first mortgage the qualifying worksheet that we went through. There are additional form requirements in other states, and again, this is not available in Alabama, Alaska, Hawaii, Louisiana, Mississippi, Oklahoma, Texas, and West Virginia. This is a list of your submission requirements. This is located on the FAM Platinum portal, and so you can find that there, and that's under your submission forms. It's required for submission, your wholesale loan submission form. And you'll notice in there is a spot to be able to click on there, the FAM facilitated TCF second HELOC. And so you want to complete the submission form. Be sure to enter the information, the HELOC line amount, the HELOC draw amount, and then the rate. And so work with your FAM account executive, especially the first ones you're getting through. The required form number 2 is the notice and authorization concerning your loan application. And so you see that there under the FAM Platinum portal. Go to the Resource Center, Loans, and then TCF HELOC to download the notice and authorization concerning your loan application disclosure. And you'll see here, so you'll complete the upper portion of the notice and have the borrowers complete the bottom portion, and e-sign is acceptable. Now remember, if you're sending this electronically, you want to make sure you're sending electronically in a secure method. The required form number 3 is your TCF qualifying worksheet, and this is also required for submission. So this worksheet is used to calculate your HELOC start rate, the 30-year P&I payment, and payment shock. The broker is to complete and submit it. A handwritten worksheet is not acceptable. So this worksheet, you can input the information. The calculations are automatic so it's auto-calculated. And once you go through it, then you must convert it to a PDF prior to uploading it to the FAM portal. So steps you want to go: pick up the TCF qualifying worksheet, input the information on your computer. The worksheet's going to auto-calculate based on the information you put in there, and then you save that worksheet as a PDF. So don't save it as an Excel spreadsheet. Save it as a PDF or as a Word document. But you want to make and save it as a PDF. So click on File and Save it as a PDF, and then upload it to your FAM portal. So those are the steps that you're going to follow. And again, work with your FAM wholesale account executive, because they know the flow, they know the process, and they're here to help you to be able to get through those. So I am going to now see what questions we have. And John, I know you've been kind of working on that as far as looking at the questions. So you may have a couple you want to hop in and answer.
Yeah, for sure. So I saw one from Lori on the approval good for 30 days. So you would not need to, we would not require you to resubmit the file after 30 days. The best thing to do is just reach out to your wholesale rep and just make sure that everything's valid. But we would still keep the submission on our system. There'd be no resubmission. We just want to ensure that the income's good, the credit's still good. And then anything after 30 days, if like the prime rate were to increase, we'd be qualifying at the higher prime rate. So we can leave it exactly the same TCF ID number that you had originally.
Cool.
And then,
did you see the disclosures too, John? I'll let you, or maybe Joanne, you can address that as far as disclosing, because it's a little bit different, because the second is not going to be included in what they're doing on the loan estimate. So we might almost want to get into, and this is something we can talk about, is doing another follow-up webinar on completing the disclosures when you're doing a combo on this. But you know, it's going to be a little bit different from what they're used to, because obviously HELOCs, we're not having the loan estimate. That's something you're doing the disclosures on. So when they're structuring this, we want to make sure that they're structuring it correctly and not putting any fees into the loan estimate that would actually go on to the second, right?
Yeah, hi, this is Joanne. So basically the TCF charge of $295 really isn't going to be going on your loan estimate, because it's not a first mortgage charge. So you really do not have to complete a loan estimate for the HELOC. We're going to be responsible for sending our command credit application disclosure to the borrowers. We do that when we receive your submission, and we actually are responsible for disclosing the fees to the consumer. We do it with that disclosure. So your only TCF disclosure responsibility is that notice and authorization form that has to be signed by all the borrowers.
Gotcha. Okay, very good. So we've got the 30 days, and I see a question here on, as far as condo projects, a question on closed sales.
Sure, I'll answer that one. So basically, if this is a new construction project, TCF does not have a pre-sale requirement. We're simply going to look at any units that are sold and closed. If you are able to finance the first unit that closed in a project, you could put a TCF HELOC on that, because that would be the only unit closed would be 100% owner occupied. But we only look at units that are sold and closed, and of those closed units, 70% must be owner occupied, and that's in the specific phase that you're lending in.
Interesting. Okay. And we have a question here as far as investors and their source of income is from rental properties. So
And
would
you know
you
that
consider that?
that borrower is just not a good fit for TCF because we really are only using rental income to the extent that it offsets the mortgage debt on properties. So if you've got a borrower and their primary income is a positive cash flow from rental properties, that's not a great fit for TCF. And of course, we do have that restriction on 6 properties, whether financed or free and clear.
Gotcha, makes sense. How about hobby farms on the subject property?
Yeah, and it looks like Julie had said also that they had other income to qualify. As long as you're not using the Schedule F for qualifying, generally we are okay if they do have a hobby farm and file a Schedule F, as long as it meets like the acreage and other requirements.
Very good. Okay.
I think Chris had a on the Q&A. Can you do a refinance loan with a cash out on the first and cash out HELOC? Is there a max LTV, CLTV? And yeah, well, however you're going to structure your first, whether it's rate term or cash out, we actually are not too concerned with the first and how it's structured. And you can go up to 89.99% CLTV. Generally, we see the first at 80%, but we have gone behind FHA loans before. So as long as it meets our 89% CLTV, we are fine with however you want to structure the first, whether it's rate term or cash out, and it doesn't matter on your LTV on that.
Okay, good.
And then I think.
Go ahead.
Oh, sorry. Yeah, I was going to say on we will use the first mortgage FAM's appraisal. We don't order an appraisal through TCF, and for the desktop review, we actually have an internal desktop review through TCF. Is who the desktops were performed by.
So they don't need a second appraisal. They're just going to get the one appraisal. They're going to go through the standard ordering of appraisal. It needs to be a full appraisal.
Yep.
So interior, exterior. And so just one appraisal, order it through your standard process as far as ordering your appraisal. FAM's going to actually send that appraisal to TCF, so you don't need to worry about doing that, right? And then you're going to do the desk review once you get that. Okay.
Correct.
The question, is there a charge to the borrower for the desk review?
Nope. We just have the $295 TCF origination charge. There's no additional cost for the desktop review.
Okay. And I'm seeing some questions, and Jeff's asking for compliance as far as if the broker needs a copy of the HELOC disclosures as well. And to remain compliant with TILA RESPA, don't we need to disclose a GFE and a TIL within the 3 days of receiving the application? So, based on a lot of these questions that we're getting, I'm thinking we're going to have to put together kind of a Q&A. I talked to Terry about it on proper disclosures on these. But what are you seeing, because you've been doing this for a while, as far as what the requirements are? Because brokers, and especially in certain states, do have requirements they need to meet regarding disclosures, even if you may not have that requirement.
Yeah, I'll take that one. Basically, these HELOCs are consumer loans. They're open-ended credit because the borrower can access the HELOC, they can pay it down, then they can access it again. So they can continually draw on this HELOC at any time during that 10-year draw period. So because this is consumer credit, it's not subject to RESPA. This is a consumer loan, very, very different than the first mortgage product that we all do every day. Okay. So you're not required to have a copy of the HELOC disclosure. It just goes directly to the consumer. It just explains the terms of the HELOC and our fees, and we do not require that the consumer sign that or return it to TCF.
Perfect.
And then I think Mark Johnson had a quick question on the subordination process. And Mark, you could, with us going up to 89.9 for the last 5 years, we have a well-oiled machine subordination department. So we have gotten quite a few of them in the past 4 years. So yes, if you do want to redo the first down the line, you can subordinate the TCF second if you don't want to redo it at that time.
Very good.
I also saw a question regarding the condos. We had talked about owner occupancy. So it's 51% owner occupancy in an existing project, 70% of sold and closed units in a new construction, and owner-occupied in this case always includes primary residences as well as second homes.
And I think Hammond, just want to confirm we can do a refinance to pay off an FHA and PMI refinance, which is above 80%. Yeah, you just the key on those is just as long as our TCF second CLTV is 89.99 or below, we are absolutely fine with that. So just keep our max CLTV in mind, and you should be good in that situation.
Okay, very good. So I'm going to close off. We're actually about 5 minutes beyond where we should be, which is great because it's got lots of great questions. And I just put up there again a link to access the slide deck. I will be sending out a follow-up. I saw a couple of chats there that somebody was popping in and out, got called out to some phone calls. So I'm recording this, and I will be sending out a copy of the recording. So if you want to come back and listen to it, then you can do that. But the most important thing is to contact your FAM account executive. The other thing, if you're not aware, I have been working with Finance of America for the past several months in creating the FAM University. It's an online university. It's training available, and it's online and available 24/7. There is training that's available on a variety of system courses, so how to utilize the various systems through FAM, how to order an appraisal, how to do a forward lock, how to request disclosure only, how to request loan docs, that are all available within the FAM University portal. We also have courses on FHA as well as VA, and then we'll be creating training in there as well on this product. And so if you'd like to access, if you haven't already, to gain access to the Finance of America University, there is no charge for it. It is for Finance of America customers. So you can ask your FAM account executive for a code to access the new FAM University, and then you'll have access. I think we have more than 60 different courses in there, and it's really training on everything, and it's available 24/7, and it's available on your phone, on your iPad, on your computer, whatever. So we're very excited about this opportunity. So I want to do a very quick recap. To submit first and second, simply download the forms in the TCF Bank HELOC library. Indicate you want to add a HELOC on the new submission form. Complete and submit that with your first mortgage and the WSL notice and authorization form, and have the applicants execute that. And then complete and submit with your first mortgage, the WSL qualifying worksheet, and any additional forms that are required for the state that you're in. And we want to thank you so much for your time. Obviously, contact your Finance of America account executive if you do have additional questions. They are here to help. And they have access to two great resources with Joanne and John. Fabulous information. I thank you so much for joining us today, and we wish you a very happy Easter weekend. And we want to thank you for joining us in this webinar. So thank you so much.